Thank you, Anne. So hi, everybody. My name is Corrine Bielejeski. I am a member of the Contra Costa County Bar Association's bankruptcy section and one of the directors there. So thank you all for joining us for our program today. We had a request to do a tax program this year, and we thought we'd do a harder one. So that's why we're here. A little bit of background. My name's, like I said, Corrine. I clerked for Judge Jellin from 2006 to 2008 before entering private practice. And I generally do consumer cases, as well as individual creditor cases, you know, your ex-husbands, that sort of stuff. And I've had my own solo practice since 2011. So I'm glad to be here and very glad to get somebody on the panel with me who does more tax law than I do. And that is John. So I'm going to turn it over to you, John, for your intro.
Thank you very much. So I'm John Faucher, and as a few of you guys know, I am a graduate of UC Berkeley, UC Davis, 1993 law school. I spent, in my career, I've spent 10 years as a trial attorney for the IRS. And there I was basically defending audits in tax court and going into bankruptcy court and getting the pound of flesh for our bankrupt debtors and paying the federal government. I also clerked for two bankruptcy judges, Judge Alan Jaroslavsky of Santa Rosa while I was in law school. And after law school, I clerked for Judge Cassetti in Pittsburgh, Pennsylvania. And so I've done bankruptcy on and off through my whole career for about 25 years. I've been 12 years in private practice, most of that as a solo practitioner.
Thanks, John. And so what we're going to do today is we're going to switch back and forth. We've got a PowerPoint for you, which hopefully I'll be able to share okay. Alrighty, and we're going to go back and forth today on how to discharge those taxes. And I'm going to start off with kind of the basic background. So taxes, what is not dischargeable? These are all going to be found in two main code sections. That's 507 and 523. So your priority tax claims, that's the last 3 years. Your trust fund taxes, that's going to be your sales taxes, that sort of thing. Your unfiled or late returns, and I like to think of those as two different topics. And then also your fraudulent returns. So, you know, this is when they were making $5 million and they put $5,000 on the return. That is, of course, none of our clients because we would know that and we would never file the case or maybe take that client, but it's good to know what is not dischargeable. So what can we discharge? So again, this is kind of our basic review for you guys. So it's a 3-year rule, the 2-year rule, the 240-day rule, and the SFR or unfiled rule. I like to take each of these ones differently, so we'll go through those now. So the first one is the 3-year rule. The tax return was last due more than 3 years ago. So what does that mean? So what that means is that today is, August 24th, 2022. Assuming no extensions, that means that the debtor cannot discharge 2022 because it's not due yet, 2021, 2020, and 2019. They may be able to discharge their 2018 and earlier tax years, but you have to watch out for extensions and those sorts of things. The 2-year rule is that the debtor has actually filed the tax return at least 2 years ago. So again, they have to have filed a return. And what is a return? Well, it's something that looks like a return. And as we saw in that recent case that came out, you can't just fax the IRS, the Franchise Tax Board, and say, hey, here's this form, and I think it'll count. We know that they do not actually like that. They want a real return and some real information. Now, the one thing I wanted to include, and we'll get this to you guys in the materials as well, is we really want to watch out for extensions and holidays. And this is primarily for that 3-year rule. So you've got somebody who comes in and they're kind of on the border for whether or not it's dischargeable, and you're just waiting to get that April date. Well, first, you're going to check to see whether or not there was an extension requested. If so, you're going to be looking out to October. And you're also going to be checking out for holidays and those COVID delays. So for our recent tax years, you can see that we only had one normal year in the last 5 years for filing season. So we had COVID delays in 2020 and 2021. we had a weekend and a holiday. In DC, I don't know if you guys know this, but the 16th of April is Emancipation Day. So if that is the Monday following tax day on the weekend, then it's a DC holiday. And so you get that bump up in the extension. And so again, you want to watch this. You do not want to be the attorney who files a case April 16th and turns out that you were 1 or 2 days or 3 months late, early. All right, so going back to our rules, again, you're going to be looking at the taxes and you're going to make sure that they were not assessed within the 240-day period. So how are you going to know that? You're going to look at the account transcript. The other thing you're going to be checking on is tolling. So remember, if somebody files a bankruptcy, if they're in an offer and compromise, if they're doing some negotiating with the IRS, there's a chance that that assessment period, that collection period, everything is paused until they get out of it. And not just until they get out of it, an additional 30 days, often 60, 90 days. So when you're checking these dates, you want to definitely check on that assessment date. And then the last one is the substitute for return, an SFR, or an unfiled one. So this is actually a circuit split, and we are in a good circuit right now on this rule. Some taxing agencies will say if you filed your taxes and they were at all late, a day late, they're never dischargeable. Here in the Ninth Circuit, that's not true. As long as they were filed within that 2-year period, you're usually good. But you have to check to make sure, filed more than 2 years ago. But you have to check to make sure that if the IRS filed a substitute of return, that either the debtor got it in just before that substitute for return was entered, maybe it crossed in the mail. Otherwise, it's going to be treated as an unfiled return. And that kind of makes sense. If the debtor sits on something, doesn't file their tax returns for 10 years, the IRS is already doing things behind the scenes. Maybe there's a reason why that year shouldn't be discharged, because really they kind of sat on their rights. What you can do, however, though, is possibly discharge those additional taxes. So what does that mean? If Tammy taxpayer has $5,000 in her statement of substitute for return, and it turns out that she actually owed $10,000 in taxes for that year, that top part might actually be dischargeable, that extra $5,000. So aren't you guys glad this is a webinar and not a normal web meeting? Because I can't see your faces and I can't call on you. But I do have a hypo for everybody. So your Tammy taxpayer goes in, decides she's going to buy a house. And she hasn't filed her taxes for 2015 to 2018, and 2019 is just about coming due. So she goes in and files all those tax years at the same time. And she comes to see you now. And now she owes $10,000 for each of those 5 tax years. So which of those tax years is potentially dischargeable? So I like to go through them rule by rule as opposed to year by year. So first off, that 3-year rule, you can't discharge 2019 or later because it hasn't met the 3 years. So you can knock off 2019. Under the 2-year rule, these all qualify because she filed them promptly in 2020 when, before the date, before the deadline. So those have all been filed more than 2 years. The 240-day rule, we don't know whether or not there's been an assessment yet, so you'd have to check those account transcripts. And then the unfiled return SFR rule, well, when you look at those tax transcripts, sure enough, they did file an SFR in those 2015 and 2016 tax years. So those ones are probably not going to be dischargeable unless there's a difference, an additional tax above and beyond what the SFR came in for. So what does this end up looking like? This ends up looking like 2015 and 2016 are not dischargeable. 2017 and 2018 probably are. Again, you're going to check for assessments. And 2019, again, is not dischargeable because it fails that 3-year rule. All right, any questions on the basics? I'm not seeing any, so I will move on to John to talk about how to read an account transcript.
Thank you very much, Corrine. So if you're going to be filing a bankruptcy for an individual, you really do want to be looking at pulling transcripts from the IRS, calling them up, having them fax them to you or mail them to you. And if you've got the transcript download service, you can have it sent to an electronic mailbox. But you get this transcript, and what do you do with it? I mean, it's the first time I saw one of these, it took me a long time to figure out what's going on with them. But here we've got a taxpayer who's filed a return, and you look toward the bottom, you've got some ID at the top, and then you go toward the bottom and you see the return due date or return received date, whichever is later. And so that's basically the date that they are deemed to have filed their return. So this return was filed on July 29th, 2009. We can see up at the top, this is for the 2006 tax year, so it's a late return. And they didn't process it till August 24th, 2009. So what you're going to be looking for is, let's see, I'm going to ask Corrine if you can actually stop screen sharing, because I've got a transcript that I want to screen share. And let's see, we will, and where is it? And all my stuff. Here we go. So, all right, so we have the, this is going to be the next page of the screen of the transcript. And let's see, it's actually the same one. So it shows that we've got a substitute tax return prepared by the IRS. So that late return is actually a substitute for tax return. This is going to be not dischargeable according to the IRS and to all the IRS minions. But in this particular case, it was discharged because if we look right here in 2010, they had started an examination of the tax return, and the taxpayers came in and they signed a return and gave it to the auditor. And when we go and we see tax assessed by examination, the code 300 halfway down the page there, and an assessment of $11,000, that tax was assessed based on what the return was that they filed. And I was able to show this because they had a copy of the return, and it showed we owe $11,493. It wasn't the IRS assessing what they thought they owed on the substitute for tax return. But the IRS didn't discharge this until I had to write a letter several months or years later to say, hey, you missed this one. So those are a few of the things that you're looking for. You're looking for, when was the return filed? And so do we have 2 years since the return was actually filed? Was the return actually due more than 3 years ago? And when was the assessment? More than 240 days ago. Usually that only matters when you've got some kind of audit going on. And let's see, I am going to go ahead and stop my screen sharing so that we can go back to the, we can go back and you can screen share again, Corrine.
There we go.
There we go. Thank you. And so what you're going to be looking for is there an audit on there? And it will show, I think you saw it, examination started. You'll see whether there's a prior bankruptcy. If they filed bankruptcy during the 3-year period, that will toll the that might toll the 3-year period for the period they're in bankruptcy. You want to look and see whether any liens were filed. That will show up on the transcript as well. And if there are notices of federal tax lien filed, go ahead and get copies of them, and and make sure that you know all about them and whether there's any liability still owing on that lien notice. And then you're going to be looking at the proof of claim. If you're filing bankruptcy and you've got a 13 or an 11, or a Chapter 7 that has some kind of dividend to the creditors, you're going to have people filing proofs of claim, including the IRS. And they're going to divide it up into what is general unsecured, which is going to be discharged, what is priority, which won't be discharged, and what is secured by the tax lien. And so very important to figure out what the differences are here and how you're going to navigate this. Yeah, so I mean, that's another way to figure out what is on the account transcript. You might get this account transcript and not really understand it. You can do a Google search to go and look at what the transaction codes are. So on the far left-hand margin of the transcript on the following pages, they'll have a transaction code, and it's a 3-digit code that says this is what we've done with this account. And you can go online and find the IRS actually publishes what those codes are and what they mean, and so it's a way of kind of translating what's going on in these account transcripts. So go ahead and take it away, Corrine.
All right, so you've taken a look at the account transcript, or maybe your clients come in and they say, you know, I've got this tax debt and I really just don't think I owe this amount, right? You've got a couple of different options. Number one, you can just call John or your favorite other tax person and say, I don't want to deal with this. Here's this client, go deal, go have them. But really, a lot of these disputes will come from things like 1099-C being filed by a creditor when the debtor was insolvent. And that's something that you guys can figure out and help them file. And it's just a quick administrative thing. You file the paperwork, you write a letter, you get in touch with one of the folks over at the IRS, and they'll get that updated for you. So you do have the ability to resolve disputes if they think that there is actually this valid issue there. You also have the option of bringing something in either the tax court or even the bankruptcy court. So there's a code section, section 505, and it allows you to actually bring a dispute in the bankruptcy court, provided that it hasn't been previously adjudicated in front of the tax court. So what that means is the IRS or the state may have already assessed, audited and assessed a debt and said, this is how much you owe. That's all fine. You can still come into the bankruptcy court and argue about it because they haven't actually been in front of a judge with all their rules and information and been able to get that number figured out. And again, if this ends up being a case where they don't need a bankruptcy, then they would just be doing that in tax court. And I know some of you here are probably tax professionals, but for those of you who aren't, again, that's an opportunity to meet a tax lawyer nearby and talk to them about their options. Realistically, though, in a lot of these cases, they're coming in because their wages are being garnished. They've got a car loan that's 2 months behind. Maybe they've got a foreclosure and you're going to be filing that bankruptcy anyway. And that's why they end up in front of us. It's important to know, though, that you should try the administrative remedies first, because there are some code sections that say we're supposed to do the administrative remedies first. And that's why we all sit and wait to get a case confirmed while the IRS reviews a tax return, that sort of thing. The other thing we're going to be talking about in this section is tax liens. So an NFTL and an NSTL. So that's the notice of federal tax lien and the notice of state tax lien. And it is secured by everything. And my friend John put this lovely image up on our screen because really, when we say everything, it is, the code section does actually say it is secured by everything. Let me see here.
And
So,
it sits like a vulture waiting to feast whenever something happens.
Yeah, I was going to see if I had the code section. Oh, here it is. It's 26 USC 6321. A lien in favor of the United States is upon all property and rights to property, whether real or personal, belonging to such person. You know what it doesn't say? Doesn't say they have to file it. It just says if you're behind, they get this lien. So keep that image in mind when somebody comes in and you're looking at the account transcript and there's a lien, or you're doing your due diligence and you pulled up the county recorder's website and you see a lien on there, they don't care about exemptions. They're going after it. So what are you going to do if you see a tax lien? So the first thing you're going to do is you're going to read it. You're going to find out what years it's secured by. You're going to figure out whether or not it's IRS, Franchise Tax Board, CDTFA, a different taxing agency, whether it's EDD or somebody else. And remember, we're not just talking about California. So I've seen Hawaii, I've seen other states as well, maybe when the debtor's working in a company, in a business. These are statutory liens, meaning that they arise under the statute rather than a judgment lien. And again, they're secured by everything the debtor owns. As a practical matter, though, the IRS rarely goes after retirement accounts, but they may in extreme circumstances. So this is where looking at your values in your Schedule AB actually matter. And the reason for that is if you're filing a case and your client wants to value the dog at $200 and you're like, the dog's only worth 20 bucks. In a normal case, it doesn't matter, right? You're looking at your schedules and both of them are exempted. But here, if they've got a tax lien and you're going to be paying for it in full through the Chapter 13, that's a $180 difference between a $200 dog and a $20 dog. Or as one of our Chapter 7 trustees once told me, 37 cents is what a dog should be valued at. So keep that in mind when you're valuing your assets, and really take a look at those. And then you're going to decide with these tax liens whether they're just going to ride through the case, whether the debtor is going to pay the lien through, say, a Chapter 13 or just ride through in a 7, and whether or not you're going to file a motion under 11 USC 506. So let's talk about our those options, right? So can the debtor afford to pay all the assets that they have? And, 5 to 10 years ago, when our housing prices were lower and the mortgages were higher, maybe they didn't have a house, maybe they lost it, and maybe they could come in through the case and file one and it would be fine. But now maybe it's going to be too much. Maybe the dollar amount's not going to work. So keep that in mind in terms of figuring out which chapter is going to be right for you to file. The other thing we're going to be looking at in these cases, if you're trying to decide whether there's a tax lien, is they usually show up after the priority period. And that makes sense, right? Because during that first 3 years, they're not dischargeable anyway. So what does the IRS care if it's liened or not liened? So right around that 2 to 3 year mark is where I start seeing the tax liens go into effect. The other thing you're going to be doing, again, you're going to check that account transcript. You're going to pull the lien from the county recorder's office and you're going to look at the dates on it and see how long ago it was filed, because those liens are invalid after 10 years unless they're renewed. The bad news for us, though, is that they are an automatic renew. So you can almost always count on those things to get renewed about 6 months beforehand. And then if you get, and don't just go by the tax claims, because sometimes our taxing agencies will file an unsecured tax claim when they know that, let's say the IRS has a priority over them in terms of security interest. This is one of those times where it's pretty rare where the proof of claim doesn't matter. If they've said it's unsecured, the lien continues to ride through the case. So unless you file that 506 motion to value the Franchise Tax Board or CDTFA's lien at 0, they will be more than happy to collect from the debtor after the bankruptcy. And maybe they'll count if those debts were dischargeable. Maybe they'll discharge them at the end of that 10-year period and not try and renew that. But you don't want to be the attorney who's dealing with a client refinancing their house or selling it with the tax lien out there. So you definitely want to be looking at these 506s. To file the 11 USC 506, you might be able to use the short form for personal property. I was able to do that a few years ago, but haven't been able to do that one. Oh, thanks, Mike. So Mike's in the chat, Mike quoted the lien attaching to the assets, the estate in Chapter 13. So this is a big one. I had a case where we specifically listed the retirement accounts and said that they were not property of the bankruptcy estate. And then we valued the assets for, we did 506 motions for the IRS lien and the franchise tax board. The IRS actually stipped to value. Yes. See, that's why you do good values on AB and then they stick to it. And then the franchise tax board got a 506 motion through. And we got to use the short form, that like 3-page combined one, and filed that, and it went through no problem. And then the franchise tax board gave back the lien, right after the case. So it was really nice. Now, it's important to realize here that we can't do the 11 USC 522 because, again, this is a statutory lien, not a judgment lien. All right, so special Chapter 7 issues. There are no 506 motions in Chapter 7. So that means the liens are riding through or they're getting paid. And now is where I'm going to scare you. So there is a case. I can't remember if I made a slide for it or not. Let's see. All right, so there's a case called Hutchinson. These numbers are not Hutchinson numbers, but I liked these numbers better, so that's what we're using. So this is the Hutchinson problem. You file a Chapter 7 case. They've got the house is worth $1 million. The first is 300K, second is 100K. They've got tax lien that's broken up into the main tax lien portion and the penalties portion. And then they've got 400K worth of equity. You think, hey, no problem. I've got a homestead in California now. I can protect this for 600K. Trustee's not going to sell it. We are great. This is fantastic. Chapter 7 case all the way. Not so fast. So here's the issue. A Chapter 7 trustee has the very easy ability to step in and avoid the penalty portion of the tax lien. You, the debtor, can't do it, but the trustee can. So if you see in black on that schedule section, that $100,000 in your schedules just became $100,000 worth of value for the Chapter 7 estate. So the trustee is going to get permission to sell the property. And the penalties portion is not going to get paid out of that sale. It's going to get paid. It's going to get paid from the estate, just like all other general unsecured creditors. And your client's going to get $400,000 in a check from the escrow company, but they're not going to see that 100K, and now they don't have their house. So you really want to watch for this in Chapter 7 cases if you've got tax liens. And really the moral behind the story is don't file a 7 when you've got these issues. And you can figure this out by looking at the tax liens and looking at the numbers. There are a couple of different ways you can avoid this. John and I were talking about it. One of the ways you can do that is actually getting a HELOC, right, John?
Yep. Yeah, go ahead
Yes.
and get a home equity line of credit that pays off the tax lien and not much else, and then you walk away with all the with your house and all the equity in it.
Yep, and then you'd still be able to file that 7, and the trustee, as we know, isn't generally speaking allowed to try and get in and negotiate with the mortgage creditors, especially in Northern District, because we had so many issues with that trustee who is doing that. It's really disfavored, especially in Northern. But that's one way of doing that. The other way is you file the 13, right? Trustee doesn't care. At least most trustees don't care. And they're just going to require you to do something with that $200,000 tax lien. And otherwise you can include that in the case. The other thing I wanted to tell you guys about Hutchinson and that specific case, again, the numbers are different, but what they tried to do is they tried to, how do I say it nicely? They tried to avoid the tax lien by using the trustee's powers. And so by doing that, they alerted the trustee that there were penalties that could be avoided for the benefit of the estate. And so had they not even brought that motion, I don't know if the Chapter 7 trustee in that case would have even noticed. So, maybe they would. Every Chapter 7 trustee is different. As we know right now, the cases, especially the asset cases, are few and far between. So keep that in mind if you've got a case like that. And we do have the site for Hutchinson in the materials so that you guys can read it. But this is the image I wanted you to keep in mind is whatever that penalties is, If it's a big enough dollar amount for the Chapter 7 estate to actually have a meaningful distribution, they're going to go after it.
Yep.
All right, on to you.
Okay, thank you. So we've got, if you've got a debtor who had a business and has a tax issue that involves personal liability on the business's tax, then you probably have a problem in your bankruptcy case. So taxes that are not dischargeable are trust fund taxes. If you were supposed to collect and forward a tax on behalf of somebody else, for instance, a payroll tax, a sales tax, things like this, taxing authorities can make you personally liable, and usually these taxes are not dischargeable. But there's some nuance to this, and some unexpected twists and turns. So IRS payroll taxes, if you get a personal liability on that, it's called a trust fund recovery penalty. It's not dischargeable. It's the IRS sees that as an unindicted crime. They're going to be pretty nasty to you. They're going to come after you to make sure that you pay that in full as best that they can collect from you. And it's absolutely non-dischargeable. If you don't pay payroll taxes in California for the EDD, surprisingly, a lot of those taxes are dischargeable. There are cases that talk about EDD taxes being discharged. And this is something that I've been practicing in the tax and bankruptcy world for years, and I only discovered this about 2 years ago. But if you've got a payroll tax liability, and I've got a fellow who's got $1 million worth of that, and we will be able to discharge it in a bankruptcy. And the big one is, another one is sales tax. If you run a business, you have a store or something, and you don't collect sales tax, the CDTFA is going to come in and they're going to do an audit. And if you've ever had a client audited by the CDTFA, it is just a nightmare. It's they do an audit in a way that makes no sense. It's some kind of mathematical program, some mathematical formula that you need a PhD in math to understand, but they can assess a huge amount of sales tax against you, against your business. And if it's an incorporated business, they can make you personally liable for that. In every other state except California, that is a trust fund tax. In California, it's not a trust fund tax. And so it's dischargeable in bankruptcy. But then the question is, when is it dischargeable? Well, you've got to go through all the rules, the 3-year, the 2-year, the 240-day rule. Well, if you're talking about a tax that is assessed against the individual, there's no tax return that they were supposed to file. I mean, they're supposed to file a tax return for the business that owes the sales tax, but the individual, me, John, owner of business, I don't owe any kind of report to the CDTFA saying that I'm personally liable for the sales tax. So we don't worry about the 3-year and the 2-year rule, but we do worry about the 240-day rule. And there you've got to figure out, when was the assessment? With the IRS, it's really easy. You can look on a transcript and it says, when was the tax return received, and when was it processed? I guess if it's a late filed tax return, I'm probably going to look at the date it was processed as the assessment date. But by rights, it's the day they received the return that should be the assessment date. But the state won't tell you that. They won't tell you when this is actually assessed. And if you call up people at the state and say, when was this tax assessed, they'll give you the wrong answer. And so I had a case where this was actually going on. Somebody had a huge amount of sales tax, $800,000 he owes to the state, and he had a guy who filed bankruptcy for him, and the state said that, a year later, you owe this money. You owe all this $800,000 of tax. And he says, but I discharged this in bankruptcy. And the state said, no, you didn't. And they didn't say anything further. And so, he then comes to me. I wasn't the guy who filed his case. And and I had to go to the legal department of the CDTFA. When is the actual assessment date? And the way the state works is they send you a notice of proposed assessment. And they say, do you agree with this or not? And if you don't agree with it, you file a petition. But you can write in and say, I agree with it. Well, if you agree with it or you don't petition it, the assessment becomes automatic after, on the date when you were supposed to respond to the petition. So if they send it out on April 15th, if they send out their notice on April 15th, and it depends on whether you're talking about sales tax or income tax. If it's the FTB sending it out, it's income tax. You've got 60 days to file your petition. If you don't file a petition, it's assessed on the 60th day thereafter. If it's sales tax and they're trying to make you personally liable, they give you 30 days to file your petition. And it's not assessed till the 30th day. And if you get that thing on April 15th and on April 16th, you write in and say, yes, I agree with this, please assess me. They're still going to wait the 30 days. You're not assessed until May 15th. And so, and nobody's going to tell you this. So I think my practice when it comes to discharging taxes like this is wait as long as possible. If you don't absolutely need to file the bankruptcy on this date, wait until you're really sure that the 240 days have passed. Because really for the FTB, it's 300 days after they send their notice is when it's dischargeable. And it's 270 days after they send its notice that the CDTFA taxes are dischargeable when they're personally assessed against you. So, yeah, so it's basically, pay very close attention to this. Talk to people, if I've got a question about this, I'll call other people who know as much or less or more than I do about this, but you don't want to make a mistake. And so reach out to other people. And then of course we're always trying to, we're always trying to work with the tax agencies. And, if you can settle something like this, it's great. If you can get the taxing authority to agree that, maybe we won't assess $100,000, maybe we'll assess $90,000 on them, great. And then, you get some kind of agreement, you've got a specific date when this actually occurs. And that's a great thing to do. So anyway, back to you, Corrine.
All right. And just a couple of quick things to add on this personal liability, because I had a case, Chapter 13 case like this, where they had a mom and pop business before the filing, and the state had yet to assess the personal liability. And I asked at my, friendly CDTFA attorney, hey, when does this file? And she goes, oh, you filed already? Great. We speed through those ones. She goes, there's a deadline for us to do the assessment if they've actually filed. Otherwise, you, on behalf of the client, can actually request a determination from the taxing agency. So you can say, hey, they had this business, we see this debt. I think, we all know that John owner is going to owe the taxes for it. Can you guys please assess now? And that way you can start the clock. And again, if you're doing a 13 and you're going to pay it in full, that's one thing. But if you're looking at anything that is going to potentially, John debtor is going to need a discharge, you're really going to need to get that assessment done. I will tell you, on the case that I have, they did each line item for why they were liable was a different letter of the alphabet, and they got all the way down to M. So they had that many different things, and it was clear, right? It was my client who ran the business and was a contractor. And so it was every single thing. You signed this one, you signed that one, your name is here, your name is there. And I mean, thankfully we knew, but can you imagine a case where that wasn't the truth? The other thing I'll let you guys know, and this is a nice change from the IRS, is that now the head coffee maker is not automatically liable for the IRS debt. So sometimes you would find that somebody who had no real interaction with the business, but happened to be the person who who was the accounts payable clerk, would find, the tax debt linked to them. And they've gotten a lot better about finding out whether or not this person actually had any ability to pay things and any authority. And so if you have that client who comes in and they say that there's this liability, again, that's where that 505 action might come in. But a lot of times you can just explain it with a letter. Or, a nice phone call to somebody and at least get a feel for where things are going.
Yeah. And a Chapter 13 is a great venue for doing that.
Oh, yeah.
Yeah.
All right. So this one was actually new to me. And in putting together this program, we tried to get some tax folks from the state to come join us, but they have a few different requirements. And one of those is that everything that we say has to be approved by the agency. Beforehand, all the handouts have to be approved. And so it's a little difficult, but they gave us something that that they wanted us to talk about. And that is something called a short year return. So I have a question for you guys in the chat or in the Q&A. If you have ever filed a short year return, I want you to tell me if you've actually filed one. And I can even do the Jeopardy music if we've done that. I've got one no from Carl so far. I honestly didn't know these existed, and I took so many tax law classes in law school. And that probably explains my GPA in law school, because the level of difficulty there. Why did I take a state and trust tax? Like, not a good idea. All right, so what you can do with a short year return is you can actually file a request with the IRS to end your tax year early. And so you can say, okay, it's 2022, it's August. I already know what this is looking like. And Mike's got the exact right idea. So Mike,
Yep.
Why didn't I add you to the panel? This would have taken so much time off of me. So what you can do is you can file a request to split your year up. And this is really easy and automated. If you've got a business and it's switching to a corporation from a partnership or from a sole proprietorship, you can start new days and that goes pretty automatically. But to change it for something else, you fill out this form, you tell them why, and they'll approve it. And then you just file your normal return. And remember, at the top of your return, it says what your tax year is. So if it's anything other than your traditional tax year, you just write in what that tax year is. And so the only time you're really going to see this is when you have a wildly different financial circumstance in two different parts of the year. So let's say that you've got a debtor, business debtor, and they've been going through and selling off all their assets to try and save the business. And at this point, maybe they're a landlord and they've sold off 5 rental properties and they're trying to make things work to save their house and this other rental. And so at this point, they know that they're going to have a big liability. And they know that they want to walk into bankruptcy court and they want to include this in their bankruptcy plan and they want to have that number. So they're going to file a short year return. And then that way, everything that they owe up until that date, it's already going to have been reviewed. They're going to file their return. They're going to have that number. And sure, the IRS can disagree and the state can disagree on that number, but they're going to have a number and be able to include that in their plan. The other reason I've seen this used is if you have a carryover loss that you want to get applied or some other thing where you really want the Chapter 7 estate not to get it, that chunk of money. I've seen a recommendation to do that. Quite frankly, I think the Chapter 7 trustee might have a little difficulty with that if you were turning around and trying to do that. But, that's for you to fight with the Chapter 7 trustee. The other thing I wanted to let you guys know is in researching this, I wanted to include a picture of the paperwork for how to do it. And I was flipping through the instructions and it said to learn how to do this and to fill out the form, that the government has to tell you how long it'll take you to do this. They said it would take between 7 and 8 hours. So if you've never heard of this before and you're not sure about it, our practice pointer to you is know that it's going to take you at least a day, according to the IRS, to review the paperwork, figure out how to do it, and which lines to fill in. But of course, if you had a case where this was a big enough deal, you'd probably be doing that anyway. It's going to be one of those big tax cases that kind of eats up your time.
Yeah.
But that's a reason to think about doing that. And honestly, the governmental, the taxing agencies would prefer that you do this than to have a question mark when it comes time for what the claim is actually going to be at the end of the day.
Yeah. And yeah, so just to expand on that a little bit and maybe overlap with what you said, Corrine, that one place where you could do a short tax year return is if you're filing a Chapter 7 and you're going into it knowing you've got some assets that are going to be distributed, and you know you're going to have a tax debt. You do the short year return, you get a tax debt, and that goes into the estate, and then you are individually liable for your tax for the rest of the year, as opposed to being individually liable for the tax that is assessed after you file your case.
Mm-hmm.
So anyway, yeah, should I go on to we've got what a bankruptcy can get you, and that's you.
Yeah. All right. So bankruptcy versus an offer in compromise. So I put this one in here because we're trying to figure out how to best help our client, right? Client walks in the door and maybe they mostly owe tax debt, right? And maybe they don't want to do a bankruptcy. Maybe their bankruptcy is going to be 100% plan. Maybe they've got tax liens, and so you're going to have to figure that out. And so you can go online and run a little OIC calculator, and you can go online and do your bankruptcy calculator, figure out what's going to work for the debtor. And really, my recommendation on these cases is figure out what's going to happen. Now that we know about this Hutchinson issue for Chapter 7 cases, you're going to watch that. You're going to really check on those penalties, the penalty portion of the tax liens, and you're going to see whether or not the debtor can afford it. So, of course, in a Chapter 13, you're going to be paying what? You're going to be paying your priority taxes. And unless the IRS steps to a different thing and will allow the secured taxes to ride through, you're likely going to be paying those too. Now, the IRS will sometimes stip to that, and you can also still file a case that's a no discharge Chapter 13 that just sticks them on the payment plan. And so this is for your guy who was making millions of dollars and owes millions of dollars in tax debt and never filed the returns. So these debts are just never dischargeable, right? They, tons and tons of money. And so you could do that no discharge 13 and just stick them on a payment plan and just keep doing serial 13s forever and ever. And just to free it, free this poor guy up. I don't know. How old do you think this guy is, John? Yeah.
He looks like late 20s, early 30s.
Yeah, so he made some bad decisions early on with crypto, and now he has no money. So so that's an option. But we also have this offer in compromise, and it sounds really great and really exciting. Tell us more about the offer in compromise, John.
So yeah, this is what's being hawked on the radio all the time. We can cut your tax debt by 50, 70, 90%. And the offer in compromise, I spent 10 years as a trial attorney at the IRS, and one of the things I did was I reviewed offers in compromise for legal sufficiency, and I probably reviewed 10,000 of them. And I advise people to avoid them if they can. The offer in compromise is actually a contract with the government. Until you do an offer in compromise, you are not in a contractual relationship with the government. You've got the leather jackboot of the state on your throat, extracting your wallet. But then the offer in compromise, you're suddenly starting to make some kind of settlement with the IRS or the tax agency. And what you're saying is, you taxing agency can come after me, and for the next 2 years, if you come after me hammer and tongs and extract everything out of me you can, you're going to get X amount of dollars. And to give you some consideration, I'm going to give you, the taxing agency, X plus $1 today. And in return for me doing that, you, the taxing agency, are going to give up something on your behalf. You're going to give up the right to collect the rest of the taxes that I owe. And so you've got a valid contract here between you and the taxing agency. And the problems with offers in compromise, the first thing is you've got to put your future income on the table today to get this settled. The people who get offers in compromise accepted are usually these are people who will never work again, or somebody who has a very rich uncle who can pay off something, their future tax debt. About 40% of offers in compromise are accepted by the IRS. I don't know what the figures are for the state agencies. I think it's a lot lower. But there are places where the offer in the other problem with the offer in compromise is, compared to bankruptcy, your pockets are even more turned inside out and empty than after bankruptcy. And after bankruptcy, you get to walk away with your state exemptions. The IRS does not apply state exemptions to an offer in compromise. You have to liquidate all your assets. Every asset that can be sold is going to be liquidated to get an offer in compromise approved. So why do an offer in compromise? Well, there are situations. This guy who we've just determined lost a lot of money in crypto and didn't pay any tax and didn't file any tax returns for years. He owes a whole lot of non-dischargeable tax. Because he didn't file a return, he can never discharge that in bankruptcy. The IRS will do an offer in compromise for a person like that. Payroll taxes. If you've got taxes that are due to fraud, these are all things that are not dischargeable, but you can, the IRS will discharge them through an offer in compromise, provided that the offer is sweet enough. Now I said, fraud, that's a difficult one to get through at the IRS, but I've seen it done. It's a rarity. The state taxing agencies are even more hard-nosed about this. You really have to, it's very difficult to get these approved by anybody. For the IRS, the first person who's going to be reviewing your offer in compromise is a GS5 clerk in Memphis, Tennessee, who has never been in a California grocery store. And so they are going to apply the national standards as harshly as they can. And it's just a nightmare to try to get approved. But there are cases where they will do it. Eventually, after Memphis invariably rejects it, they will send it back out to the field, and you will be working with a revenue officer out here in Glendale or Albany or wherever they have revenue officers who actually has to pay California real estate fees and stuff like this. So anyway, that's my take on the offer in compromise. Don't do it if you don't have to.
And the other thing to know about the offer in compromise, if you've got a client coming in and they're in the middle or especially towards the end of the offer in compromise, if they file while the OIC is ongoing, it's gone. So whatever sweet deal they have, it's not like the car loans where, oh, I've got a couple more months left and we're done. The offer in compromise disappears and you're back to square one. Of course, they'll go through and credit the payments, but that deal goes away. So again, when you're looking at that account transcript, it's going to tell you if they're in an offer in compromise. Yeah.
Another thing to know about the offer in compromise, and we haven't talked about this much, but I work with it all the time in tax and bankruptcy, is the collection statute expiration date, the CSED. The IRS has 10 years to collect any taxes. On the next day after 10 years are done, the taxes just disappear. Boo, they magically go away. The offer in compromise is going to toll that CSED for the period of time plus the offer in compromise, the period of time plus 30 days. Bankruptcy tolls that for the period of time of the bankruptcy plus 6 months. And so these are, if you are looking at somebody who has a 9-year-old tax liability, you might think about something other than bankruptcy or an offer in compromise.
And that's where those lovely installment plans, I give you this money, you don't raid my bank account, come into play. All right, well, we are just at 1 o'clock. So here's our note on priority taxes. John, you want to give our note?
Sure. Yeah, so priority taxes, I think we all know what it is. It's the taxes that were last due less than 3 years before the petition was filed, or the tax return was filed within the last 2 years, or the tax was there was an audit and the tax was assessed within 240 days. And so those are the priority taxes on a proof of claim. They're going to show up as the second level, the first level being the secured taxes, then the priority taxes. And priority taxes are not discharged, and in a Chapter 13 or a Chapter 11, they've got to be paid in full before you can get a discharge. or they got to be paid in full to the estate has to pay them as much as possible, and then you get a discharge. You can get a discharge. Those taxes are not discharged if they're not paid in full. And then you go on your merry way and you still have to pay those taxes. You know, one little wrinkle that I've run into is that actually the taxes that were where the tax return was filed less than 2 years ago, but the tax return was last due more than 3 years ago, that is actually not a priority tax, and that is not a dischargeable tax. And so that's a surprise in some Chapter 13s because that shows up as general unsecured. You know, you might owe $50,000 for that tax year. You're paying 3 cents on the dollar in your Chapter 13. It doesn't get paid through the plan. And then you come out and you still owe most of that $50,000 tax debt.
Yep. And that's why you have to read that account transcript, or you know, try and get some alternate arrangement in that Chapter 13, right?
Correct. Yeah. Yeah. So.
All right. Well, that was we actually made it to the end of our presentation. I'm pleased with us. We had so much to go over in here. We are very happy to answer your questions. We specifically set this up so that you guys had time to ask questions. So please, if you've got anything, you've got a case right now where you're fighting with somebody, we would love to hear about it and try and help give some advice. We hope you found this a valuable experience today, and you at least learned about short year returns, because again, that was a new to me one.
Mm-hmm. So from the honorary member of the panel, Michael Primus, great job. Thank you very much. Appreciate that.
Yeah, thanks, Mike.
Anybody? Questions?
Well, we made sure to put our information in the agenda so everybody has it. So if you've got something, you know, meaty and you just didn't want to ask in front of everybody because you didn't want Mike to solve it before you did, you can let us know.
Yeah, and we are real nerds about this stuff. We love to talk about it.
Oh, you got one.
We got one.
Are you familiar with offer and compromise?
Doubt as to
was that an old one?
Doubt as to liability. Yeah, actually, that's a good point. There are 3 ways of submitting an offer and compromise. And you can do an offer and compromise doubt as to collectability, and that's the standard one that we talked about. I'm giving you IRS everything that you could get plus another $1, and you write off the rest of my taxes. But you can also say, hey, I really shouldn't be owing this tax liability, and here's why. It's a little bit like doing an audit reconsideration, or going back after the fact and saying this assessment is wrong, and here's why. This is an inflated, it's an inflated assessment. And so yeah, that one, if you've got a good story and you've got some documentation, but maybe not everything, that's worth doing. It's doubt as to liability. And then there's what is the last one? It's for effective administration, effective tax administration. And this is basically a PR move by the IRS. It's the person who actually could full pay, but it just looks bad if the IRS were really to collect everything from this person, because it's a 90-year-old widow living in a full paid mansion, and she still owes hundreds of thousands of dollars of tax, but all she's getting is Social Security. And so we don't want to continue garnishing her Social Security, and we don't want to kick her out of the house and have, the LA Times or the San Francisco Chronicle talk about how the IRS is, putting mean little widows out on the street. And so sometimes they'll do effective tax administration and write off some of the taxes just for good PR.
All right, and then we have a question from Carl asking about why the Northern District is different from other districts regarding Hutchinson and trustee sales. and also compromises and deals with mortgage companies. Carl, this is before our time, but we had a Chapter 7 trustee who I believe got indicted. Those of you who are more senior in the bar can help us out, but he was doing some bad stuff. And we're not just talking carve outs, but selling things that Chapter 7 trustees should not be selling, and doing all that sort of carve out stuff just to get money for the trustee and not passing it on to creditors. So if you think we have aggressive trustees, sometimes you haven't seen anything. So it was a big deal, like I said, Carl, before you were in my time with our bar. And so as a result of that, Northern District especially, and if you read some of the cases, they'll say, we understand why you in Northern District are so worried about this, and why we don't do carve outs the same way that some other jurisdictions do. And it's because really it was trustee abuse. So that's why. Was this during your time up here, John?
No, I don't. I was not here when that was going on.
Yeah. I know Judge Jellin had one of his cases, because from time to time we'd have people bring it up in front of him, and why he was a totally unethical judge and things like that. And he just like,
Trustee,
you know, that's your opinion, you know, like moving on.
Yeah.
And, you know, obviously that was not the case, but it's really hard to explain to somebody who's not familiar with Chapter 7 law or bankruptcy law that the judge doesn't just go through your house with you. Like they don't, you know, they're a step behind all that. So they only see it when it's brought to them.
Yeah. And the trustees, each trustee has their own policy. I mean, I deal with 6 trustees in the San Fernando Valley and 3 trustees up in Santa Barbara, and each one of them is very different, and it's a different mode of operation for each trustee.
But if you're ever really bored and want to look into our Northern District bankruptcy history, you can do a quick Google search, and a lot of it will come up for that one, unfortunately. But the good news is, for the debtor side, anytime a trustee is trying to do these sorts of carve outs, especially if it's a mortgage carve out, there's some issues. But the tax carve outs are set in code. They're absolutely allowed, and not only allowed, but suggested to carve out these penalties. So this is not going to get you the same sort of, this one's going to be allowed a lot faster and a lot easier than a carve out for a mortgage. So just assume that the Hutchinson problem can happen in Northern District, whereas agreeing with the HELOC to give up $50K probably is not going to be allowed.
No.
All right. Anybody else? Last question. All right, I think
Going
that's
once,
it.
going twice.
I know.
All right. So.
Excellent. Thank you, everyone.
All right. Thank you for
See you all
listening.
soon again.
All right. Take care.
Bye.
Bye.
Bye.